The market's been on a wild ride lately, with some stocks taking a nosedive while others soar to new heights. But as Warren Buffett famously said, be fearful when others are greedy and greedy when others are fearful. So are you ready to dig into some potentially undervalued gems? Let's kick things off with our first stock, PayPal. Now you might be thinking, PayPal? Isn't that old news? PayPal has been on quite a roller coaster ride. It hit an all-time high of $310 back in July 2021, but it's been on a downward trend since then. Now it's trading at a much more attractive price point. But remember, just because a stock is cheaper doesn't automatically make it a good buy. We need to dig deeper. Let's look at the 8 pillars of analysis for PayPal. One interesting point is that the price to free cash flow ratio is lower than the P/E ratio. This is actually a good sign, indicating that PayPal is generating more free cash flow than earnings. In fact, over the past 5 years, PayPal has generated $4.78 billion in free cash flow compared to $3.5 billion in net income. That's a positive sign for the company's financial health. The profit margin has been consistently around 14%, which is solid. The return on invested capital, ROIC, isn't stellar, but it's improving. And here's something to get excited about. PayPal is buying back shares at 12 times free cash flow. When a company buys back shares at a low valuation, it's usually a good sign for investors. Now let's talk about growth. Analysts are projecting steady earnings growth for PayPal over the next few years, with estimates reaching over $8 per share in the next 3 to 4 years. Revenue growth is also expected to remain solid, hovering around 7 to 10% annually. But here's where it gets interesting. There's been a lot of chatter about PayPal being a dying company because the number of active accounts has decreased. However, the total transaction amounts and the average transaction per user are actually growing significantly. This tells us that while PayPal might have fewer users, those users are spending more. Quality over quantity, right? So why do people still use PayPal? Trust. When making high-priced or international purchases, many users turn to PayPal for that extra layer of security. This trust factor is a huge asset for the company. Is PayPal a buy right now? Well, that depends on your investment strategy and risk tolerance. Remember, in a frothy market, even solid companies can see their stock prices drag down. The key is to differentiate between a stock falling due to market conditions versus fundamental issues with the company. Now let's shift gears and talk about our second stock, Ulta Beauty. This one's particularly interesting because it's in the retail sector, which has faced its fair share of challenges in recent years. Ulta Beauty hit an all-time high of $575 just back in March, but it's now trading around $387. That's a significant drop of about 35% in just 3 months. But as we know, a falling price doesn't necessarily mean a bad investment. It could mean an opportunity. One of the things that makes Ulta stand out is its consistent same-store sales growth. In the retail world, this is a crucial metric that shows the company is able to drive growth from existing locations, not just by opening new stores. Looking at the financials, Ulta's free cash flow is slightly lower than its net income, but not by a concerning amount. The company boasts a gross margin of almost 40% and a consistent bottom line of 10 to 11%. These are solid numbers for a retail operation. One thing to love about Ulta is its share buyback program. They're repurchasing shares at what appears to be attractive prices, which can be a great way to return value to shareholders. Analysts are bullish on Ulta's future, projecting earnings per share to grow from $26 to $43 over the next 5 years. Revenue growth is expected to remain in the mid-single digits, driven by a combination of same-store sales growth and new store openings. But here's something to consider. Ulta's success is closely tied to consumer spending, particularly in the beauty sector. How do you think economic conditions might impact Ulta's performance in the coming years? It's definitely something to ponder as you consider this stock. Now let's move on to our third stock, Starbucks. Yes, that's Starbucks. The coffee giant that seems to have a store on every corner. But don't let its ubiquity fool you. There's still potential for growth here. Starbucks hit an all-time high of $126 back in July 2021, but it's now trading around $79. That's a 35% drop, which might make some investors nervous. But let's look closer at the numbers. Starbucks pays a dividend yield of about 2.8%, which eats up about $2.5 billion of its $4 billion in free cash flow from last year. Some investors might see this as a negative, preferring the company to reinvest that money or buy back shares instead. One concern is that the 5-year average free cash flow is significantly lower than the 5-year average net income. However, Starbucks has a few things going for it that make it an interesting prospect. First, there's the brand. Starbucks is a household name with a loyal customer base. Second, there's still room for growth, particularly in markets like China, India, and Africa. The company is also working on optimizing its store network, closing some underperforming locations while opening in new areas. Analysts are projecting steady growth for Starbucks, with earnings per share expected to grow from $3.67 to $6.44 over the next few years. Revenue growth is projected to remain in the mid to high single digits. What do you think is a fair multiple for a company like Starbucks? Given its brand strength and growth potential, should it command a premium valuation? Or are there risks that justify a lower multiple? Now let's dive into our fourth stock, Paycom Software. This one's particularly interesting because it operates in the payroll and HR software space, which could be vulnerable in a recession, but also has significant growth potential. Paycom has seen some significant price swings recently. It fell dramatically from $200 to around $145, then skyrocketed back up, and now it's back down to $141. This volatility might make some investors nervous, but it could also present opportunities. One of the most attractive features of Paycom is its high gross margin of 83%. This means that for every dollar of revenue, 83 cents is left after accounting for the cost of goods sold. That's a pretty impressive number. Paycom also boasts strong revenue growth potential and a good return on invested capital. However, there are some concerns. The discrepancy between earnings and free cash flow is something to keep an eye on. Also, if we hit a recession, Paycom could suffer as businesses cut back on expenses. Analysts are projecting significant growth for Paycom, with earnings per share expected to grow by 50 to 60% over the next 4 to 5 years. Revenue growth is expected to remain in the double digits. How do you think the trend towards remote work will impact companies like Paycom? Could this be a tailwind for HR and payroll software providers? Finally, let's talk about our fifth stock, Disney. Now, this might seem like an odd choice given some of the challenges Disney has faced recently, but hear us out. The play here is all about profit margins. Historically, Disney has been able to achieve profit margins of 15 to 20%. However, in the past year, that margin has dropped to around 2%. This presents an interesting opportunity if Disney can return to its historical profit levels. Analysts are optimistic about Disney's future, projecting significant earnings growth over the next few years. Revenue growth is expected to remain in the mid-single digits, which is reasonable for a company of Disney's size. Do you think Disney can successfully navigate the changing media landscape and return to its historical profit levels? What factors do you think will be crucial for Disney's success in the coming years? And there you have it, 5 stocks that could be worth watching as we head into July 2024. Remember, investing always carries risks, and it's crucial to do your own research and consider your personal financial situation before making any investment decisions. What do you think about these stock picks? Do you agree with the analysis? Are there other stocks you think should be on this list? Let us know in the comments below. If you found this video helpful, please give it a thumbs up. And if you want more in-depth stock analysis and investment strategies, hit that subscribe button and the notification bell so you don't miss out on our future videos. Remember, in the world of investing, knowledge is power, and we're here to help you build that knowledge. Thanks for watching, and here's to smart investing.